Welcome back, everyone. Today we'll be having a look at Halfords. Now, in looking at new dividend companies, I stumbled across Halfords themselves. A lot of you are probably very familiar, especially if you're based in the UK, with Halfords being a sort of household name when it comes to bicycles, and moreover in the past about decade, I would say car parts and car servicing. I know for instance, a lot of my family, you can get some relatively cheap, easy parts at Halfords, click and collect and all. You can go right in and get stuff. It's handy, I must admit. And I had to kind of pause and go, I don't want to go into this too critical of their future and whatnot, because the more I delved into them, there's actually quite a bit of opportunity, and their share price, as we're about to have a look here, is quite enticing at its current value. You could say it's quite undervalued for, Halfords. But we'll delve right into it. We'll look at their dividend. We'll look through them on Simply Wall Street, their investor side of the website, their own website, see what they provide. So let's get right into it. Okay, ticker symbol, most important part, is HFD, the Halfords Group PLC. UK's largest retailer of motoring and cycling products through Halfords Autocentre. They provide vehicle servicing, MOT, maintenance and repairs in the United Kingdom. Okay. Right, currently trading at 154 pence, so £1.54. Now, how does that translate? This is only the day, so we'll do year. Past year, they were trading at about £3.70 at the height in December, and down to £1.54 in less than a year. Okay, right. Well, we'll have to look into that, see if we can figure out what happened there. It seems they actually had a decline all the way to the pandemic, where you could have picked their shares up for 65 pence, to which they had a really good bull run all the way to June there, where they nearly got £4.40. If we go max to see any other story, they've quite a lot of peaks and downs from the pandemic into the middle of it and down once again. So again, It is telling. If the company's up and down, there is a potential chance of jumping in. This might be a good time, but we're going to look into their dividend, see long term how it looks. Dividend yield, it currently sits at 5.83%. We'll later on see that it's actually closer to 6 because of the value of their share. And without further ado, straight on to their website. At the moment, it's an article on Her Majesty the Queen. Quite a sad day for us here in the UK due to her passing. And quite unexpected. And to be honest, I planned on doing this video last week, so it's actually nice to see that this is on the website. So we'll go into the motoring side of things. As you can see, motoring products, tyres, tools, child seats, they're trying to cover everything because they know just keeping in the cycling side of things, the cycling, their market share is probably being eaten away by online retailers for cycling, because online retailers can provide certain things cheaper than brick motor stores such as Halfords actually have to pay for rent and whatnot of their premises. That doesn't mean that they have any smaller share. I know most people do a lot of people I know go to Halfords for any bicycle, especially here in Northern Ireland. They've quite a few stores and they're readily available. But they're definitely exploring into the motoring side. They also have the servicing side. I don't see much of that over here in Northern Ireland. I know it's mainly over in the mainland where you see a lot of this. And they're definitely expanding into that side, which is good to see because honestly, the car market, you'll see later on in the video that Halfords control 2% of the market. So they have a lot of room to grow, and there really isn't any clear leader in anyone doing motor servicing. Some people do it themselves. There's all, mechanics here and there, but there are big players joining into that game trying to get a piece of the pie. Offers, trending and whatnot, camping supplies, scooters, anything cycling and motor related, Halfords seem to be the ones to go to. You put in your reg, so their website obviously has a really easy function to find parts, and then you put in your postcode, and they have deals quite a bit. I've noticed this with a lot of places, Klarna, being able to spread, the cost of things So jumping in on that on their website, another good aspect to see, because that is, a lot of our economy is shifting to, you know, paying something over like 4 payments and whatnot. A decade ago, that would have been unheard of for anything other than the likes of a car or, you know, a massive purchase. And that seems relatively available everywhere. So seeing a company jump on that, always good. Okay, on to, this is actually their investment relations. I'll have this down in the description for you. And let's let Halfords take it away and see their investment case. Market leading business, okay. So largest retailer of motoring and cycling products, okay. Let's see, allows them to drive benefits in procurement, innovation, customer offering. Obviously, being the biggest in your, you know, inside of things, they can get things cheaper. And obviously, innovation, they do need to stay ahead of the competition in what they're offering. In car servicing, it's highly fragmented. That is true. My background is actually the car servicing sector, and I can tell you that the vast majority of things are carried out by usually just, you know, 1 or 2 team mechanic family run businesses, and then there's obviously dealers or dealerships, and a lot of people do their own work, and family do, you know, other people's cars and whatnot. So it is fragmented. That's very true. And they have a 2% share, and I'm sure they've plenty of opportunity to grow that share over time. Building a services-focused business. In the medium term, half of our business will be in services which are essential in their nature. Yeah, that is true. In terms of the mechanic inside, getting someone to put that engine management light off, or, you know, doing your aircon or whatnot, that isn't something I think we'll automate anytime soon, so it's pretty safe in the medium term. Note they say that, not long term, because goodness knows what we could get automated in the future. You could probably have like a drive-through. You drive the car in, it'll service and do everything for you. Crazy the world we may live in 10 years to come. So but in the medium term, I think it is pretty safe, I would say. Value creating opportunities. Our strategy will see us develop into areas with good long-term growth, such as motoring services, business to business, and electric mobility. Electric scooters and all are definitely on the uptick, so good to see them jumping into that as well. I'm trying to be as balanced as I can. I could have went in going, look, we're going to get into the financials. It's not looking great over the next, couple of years. But at least they're putting out that they are trying something. Cash generating business. Now, good cash flow is always a great thing for any dividend paying company. I've mentioned that quite a lot before. And Halfords is no exception. Good free cash flow, enabling investment and returns to shareholders. They were doing well until the pandemic hit, to which they cut their dividend. I'm a wee bit disappointed in the Halfords, but I do understand that a lot of businesses that did operate on a person coming into the store, a lot of them did cut their dividend. It is kind of understandable given the circumstances. Every business reacted differently to the pandemic, and when your share price goes to 65 pence, I can imagine there was a wee bit of an alarm bell there. Dividend returns. We recognise the importance of dividends to our investors and have resumed the ordinary dividend, intending this to be progressive. Should surplus cash remain, it will be returned to shareholders. Now, let's go on to simply Wall Street, and we're going to have a look at their wee Snowflake model and, dive down, see what's good, what's bad, and don't take everything from this as gospel. There are a few checks, and, obviously doing your own research is vital in looking into any company, but I am trying to give as best an overview as I can. So year to date, we are down 49%. To £1.54, and as I said, 2 weeks ago we were down at 127, so 20 pence down on that. Now the Snowflake Analysis takes into account value, the future performance, past, health and dividend of the business. Halfords scores 4 out of 6 in everything, well 5 out of 6 in health and past, 0 out of 6 for future in the next 1 to 3 years. Now, we are entering a bit of a recession. Unsure as to how things are going to go. The future is a little uncertain. Halfords obviously is in that category of we don't really know what's going to happen. And they're trading 15% below their fair value. Earnings grew 46%, but that's inflated due to the pandemic, of course. Most other places being closed the year before, there wasn't a super high amount of earnings. The earnings are forecasted to decline for the next 3 years. And then they have a highly volatile share price over the last 3 months, unstable dividend track record, and shareholders have been diluted in the past year. Okay, not great. That's not great. Well, again, I'm trying to be balanced in this. So let's go in to their evaluation. Scrolling on down, we can see key metric. Let's see, pay ratio is 4.2. Okay, their earnings to market, or what am I saying there? Price to earnings ratio. Okay, 4.2. It's not too bad for that industry, I would say. Obviously, every industry for their pay ratio is a little different. You know, we can get tech companies where the pay goes really high, and the likes of Tesla and all, where it goes through the roof. And then there are some that are very low in the PE, but nothing too out of the blue for Halfords. They are undervalued by 15%. They give them a fair value of £1.79. Now, obviously, you've seen from their share price that not but a year ago they were double that, you know, which you could say, you know, would they say they were super overvalued? It is based on a discounted cash flow model, and their cash flow has kind of declined in recent months, or in the recent year. Might be a reason for it, for being undervalued, but not by a lot. So we'll carry on here. We'll go to future growth, where they score 0 out of 6. They're actually projected at minus 5.5%. I do have some qualms for Simply Wall Street when it comes to future analysis, especially because, you know, it's the data is from just, let's see, who's it from? Normally it brings up who did the analysis. It's average of 6 analysts. Analysts can get it wrong. Look, I'm not a firm believer in future, you know, analysis. I'm not. I just, in my personal opinion, it is so hard to predict that. You can look at the past performance of the business and, you know, you can take a good educated guess. It is a bit like a dice roll. We don't quite know where it's going to go. And they're maybe being a wee bit harsh on Halfords. Again, there is a recession. There's a lot of factors. It's very difficult to work out right now. But to say they'll sort of stagnate for the next 3 years doesn't sound right in my book. Because the industry the industry and market's projected to grow nearly 8 to 9%, and the company is just projected to not grow, in fact negative by 5%. See, these are questions. I'm asking questions. That's all I'm doing. You know, I'm being very critical of what I'm saying, and obviously you have to take, it's a bit, you take as much research as you can, you take as good a, you know, what way you want your portfolio to go, and then of course you add in, well, you know, there is a bit of a leap of faith as well. You have to trust and be confident in the company you're investing in. I always say that, and yeah, it's pretty true. So we can see here the profit margin sits around between 4 and 5% for at least the last couple of years anyway, dipping down in 2020, pandemic. But they've actually been growing the revenue over the past 3 years, even higher than pre-COVID levels. So that's also good to see. Let's go to financial health. Okay, so there's assets short term and liabilities short term. Okay, not great, but long term, bit better. Let's see here. Their equity to debt's actually really low. Why is that? More cash than total debt. Okay. Again, so sometimes it throws me all these stats. I would probably have to crawl through Halfords' own financial sheets to get an exact measure here, but I'm pretty trustworthy on this. So, you know, financially, they seem to be an extremely healthy company. Physical assets, the inventory, receivables, and just cash sitting on hand and whatnot. Dividend is where they fall a little flat for me. They currently sit at 6%, but all is not well here. Because if we go back to 2014, dividend per share, you can see it there. It's the light blue line, not the yield. Forget the yield for a second, because I need to distinguish this from this video and future ones. Yield is their dividend compared to their share price. Dividend per share is actually a very, very really nice indicator if they're growing their dividend year on year, because, you know, dividend yield doesn't mean an awful lot. They could have the same dividend per share every year, and their yield could go up and down depending on their share price. As you can see, it got cut. They cut their share. Well, it says here that it got cut. Dividend Max has a bit of a qualm on that one. We'll have to see who's correct. Into June 2021, As you can see, it's almost halved from 2019 to 2021 on its dividend per share. Still maintaining a solid 6% dividend yield, despite being, halved per share. Now, going on down here, cash payout to shareholders, not too bad. Management gets paid a cozy $3.1 million per year. Woo, not bad at all for a wee pay package to get. And if we go down here, always interested to see who owns most of them. And we have Fidelity at 10%, BlackRock sits at 5%, and Vanguards are down at 3.67%. Very a strange pattern that I notice in a lot of companies, but I suppose they are two of the biggest asset management firms in the world. Well, I don't know if that's what they're called, but definitely they manage a lot of assets. Okay, Dividend Max, one of my favourite websites, always down in the description for anyone wanting a wee look. And we have Halfords here. So I want to be very clear on the ex-dividend date. You need to have the share the day before the ex-dividend date. For some reason, I kept saying you needed on the ex-dividend date. No, you needed the day before. Don't know why or where my thought process went for that one, but I am sorry for lying to you this whole time. You need to have the share the day before. So 9th of December is the ex-dividend date. You need it the day before the 8th. Well, obviously, August the 11th was the next dividend for Halfords. You would have needed the share on the 10th of August. Declaration date's just the date that they announce when the ex-dividend date and the pay date is. Pay date's just when it lands into your account. So yes, 10th of August, if you have a share in Halfords, or if you did have a share on the 10th of August, you'd have been entitled on the 11th. You'd have been counted as, a dividend holder. You're counted the day before. Always have your shares a day or two before the ex-dividend date. Don't try and be sneaky. It's not recommended to be sneaky and try and buy before the dividend, get the dividend, then sell the shares, because normally they're devalued the day after anyway. So yeah, if you had 100 shares in Halfords, which would have cost you a cozy £154, at the moment you'd have got a £6 payment to be paid in September 16th. So tomorrow. Hello to all you Halford dividend holders that are being paid tomorrow. Let me know who you are in the comment section below. I'm actually curious, and tell us how many shares are you rocking. When did you buy them? I'm always interested to hear who holds shares. You don't have to give exact amounts, by the way. That was just me having a laugh, but it's always interesting to hear what holdings people have. And what made you choose Halfords? It's always helpful, not even just to myself, but loads of people read the comments in this channel, I've noticed. So anything you all say, if it's a bit of useful information, I'll take it on board, and hopefully plenty of other people will, because the whole point of this channel is helping one another. We want to get more people involved in dividend investing. Not even involved, just more people aware as to what it is and what it could be doing, because as I said for myself, you could have £1,000 sitting in the bank account, savings account, and at current interest rates, you maybe get like £1 or £2 at the end of the year. But some people don't realise that not like my computer to just crash on me there. But yes, as I was saying, Halfords, it's not bad. It could potentially be a really undervalued hold to pick on right now. Into the future, I think Simply Wall Street wasn't completely accurate. Their discounted cash flow formula doesn't work so much, because Halfords actually had a major decline in overall cash. Let me just show you here. So as you can see, their operating was up and up and up, and it's a wee bit down this year. That means that formula mightn't be correct. I mean, there's so many other factors in this, but definitely I would recommend having a good look into Halfords. I am, of course, in Trading 212. This is the brokerage that I use, that I always have a wee affiliate link down in the description for you. If it's if you're in need of a brokerage, I highly recommend them, due to the lack of any fees. I don't do any CFD betting or trade betting or trade spreading or whatever. It's kind of like akin to gambling almost. I don't do that part. I only use its ISA, its tax-free ISA, to buy stocks and shares, and I use its normal invest account. So yeah, if you want to avoid any fees, don't go near the CFD side of things. But yes, that's pretty much it. That's Halfords in a nutshell here. Revenues increasing year on year. As I said, net income as well. Total assets and liabilities pretty stable. And it is a cash flow business. It does generate quite a bit of cash flow, and that is good for any dividend payer. Let me know what you think in the comment section below. Thank you for joining me, and I'll see you all hopefully in another episode. Bye bye.